U.S. consumer prices rose 6.2% last month compared to October 2020, a 30-year high. It's made markets nervous that the Fed could tighten monetary policy sooner than expected. Much of the surge was seen in energy prices, but food prices also rose sharply. Meanwhile, in Japan, producer price inflation has hit its highest level in more than 40 years, with wholesale prices surging as a result of high commodity and fuel prices. The data means the world's four largest economies, the United States, China, Japan, and Germany, have all reported record inflation numbers for October. Let's talk more about this with Chelsea Delaney, our correspondent in Frankfurt. Chelsea, economists, politicians, leaders of central banks, they've all been saying, oh, don't worry, this inflation is going to be temporary. Now, this fresh data, is that changing their view?
Yeah, I think it is to some degree, and I think it's getting harder and harder to make the case that this is just a temporary fluke. And we're even seeing policymakers like those at the Federal Reserve start to back away from using that wording, temporary, transitory. They're less confident that it's going to be like that, because really when we started to see inflation take off earlier this year, it was thought to be something caused by things like commodity shortages or energy shortages. But now what we're starting to see is it really broaden out. So food prices are surging, prices for furniture, for clothing. It's starting to be a very broad-based increase in inflation. And that's something that could really spill over onto consumers and businesses, because their paychecks are going to be worth less and they might stop spending as much. So it is becoming a bigger threat to the broader economy.
A broad-based phenomenon. Okay, so how much more likely is it that this data, what we see is going on right now, will prompt the Fed to trigger much more aggressive monetary policies?
Yeah, it's a good question. I think right now investors aren't really expecting this to make the Fed come out very, very aggressive, start raising interest rates immediately, but they do expect that maybe next year. So the Fed is in a bit of a difficult position because inflation is definitely surging, but at the same time, the labor market hasn't fully recovered from the pandemic. There are still millions of jobs shorter than they were at the beginning of the pandemic. So there's still a lot of work to do on the labor recovery. Right now, investors generally expect the Fed to start raising interest rates around the middle of next year. So that is something that could eat into the stock market gains we've seen.
Chelsea Delaney in Frankfurt, thank you.